Here we can see about IFRS, International Financial Reporting Standards. So, what is meant by IFRS? IFRS are a set of accounting rules for the financial statement of public companies that are intended to bring consistency, transparency regardless of company or the country and make them easily comparable around the world. IFRS are issued by the International Accounting Standard Board IASB. IFRS currently has completed profiles for 166 jurisdiction including those in European Union. IFRS is often confused with International Accounting Standards IAS, which are the older standards that replaced IFRS in 2001. We can understand more about IFRS. IFRS is specified in detail how companies must maintain their records and report their expenses and income. They were established to create a common accounting language that could be understood globally by investors, auditors, government regulators, and other interested parties. These standards are designed to bring consistency to accounting language, practices, and statements, and to help business and investors to make educated financial analysis and decisions. They were developed by the International Accounting Standard Board, which is the part of non-profit organization London-based IFRS Foundation. The foundation says it sets the standards to bring transparency, accountability, and efficiency to financial markets around the world. History of IFRS. IFRS originated in European Union with the intention of making business affairs and account accessible across the continent. It was quickly adopted as a common accounting language. Although US and other countries didn't use IFRS, currently 166 jurisdictions do, making IFRS the most used set of standards globally. So, who uses IFRS? IFRS are required to be the most used by public companies based in more than 160 countries, including all of the nations in the European Union as well as in Canada, India, Russia, South Africa, South Korea, and Chile. The US and China each have their own systems. Standard requirements of IFRS. IFRS covers a range of accounting activities. These are certain aspects of business practices for which IFRS set mandatory rules. First is statement for financial position. This is the balance sheet. IFRS influences the ways in which the components of a balance sheet are reported. Secondly, statement for comprehensive income. This can take the form of one statement or separated into a profit or loss statement or of other income including property and equipment. Statement of changes in equity is the third one. It is also known as the statement of retained earnings. This document states the company's changes in earnings or profit for the given financial period. The fourth one is statement for cash flows. This report summarizes the company's financial transactions in the given period, separating cash flow into operations, investing, and financing. Why is IFRS important? IFRS fosters the transparency and trust in the global financial markets and the companies that list their shares on them. If such standards did not exist, investors would be more reluctant to believe that financial statements and other information presented to them by companies. Without the trust, we might see fewer transactions and less robust economy. IFRS also helps the investors analyze companies by making it easier and to perform apples to apples comparison between one company and other company and for the fundamental analysis of a company's performance. That's all about IFRS.